All right, we're going to look at Standard 3, which is all about duties to clients. Now, again, we've talked about your professionalism, Standard 1. Standard 2 is about the integrity of the markets and the standards are associated with that. Now we're dealing with our duties as professionals to our clients and putting them above ourselves and even our employers, etc. And so there's a bit of a hierarchy there. It's really good to make sure you know those 6 different sections, and you can relate how these different scenarios are all intertwined together. Now, obviously there's going to be areas where there's a little bit of overlap, and we'll cover that as we go, but there's always going to be that. But in essence, what we're dealing with here are specific standards which are all about doing the best thing by the client and not necessarily by us. Putting the client first is, I guess, the bottom line here. So a couple of points that we have which are worth sort of talking about. Pension plan managers should act in the best interest of plan participants and not the sponsoring company. So again, it's putting the needs of those investors, those clients, those participants first over the sponsoring company. And sometimes that can be really hard. And again, this is where there may be scenarios where you have to leave a company if there is a willing breach by the company and they're acting in a way that's not in the client's best interests. You may need to act, but that is the standard. That is what is expected of us as professionals. Managers must seek the best execution. So if you are trading on behalf of clients, etc., sometimes the best execution for the client is not necessarily the one that pays the best commissions. According to the standards, we have to always pick the best execution for the clients. Soft commissions must not relate to investment decision making. That's kind of obvious, there's no area within professional finance where the amount of kickback that we get should dictate or should have precedence or priority over what we do for our clients. If the cost to the client and the benefit to the client is the same, then by all means, going with a broker, etc., who is going to provide higher soft commissions, well, there's no problem with that, as long as the best interests of the client is maintained. Client-directed brokerage is allowed. So if the client says to you, no, I don't want to use broker ABC, I want to use broker DEF, that's allowed, but it may not be the best execution for the client. And if that's the case, then it is on you as a professional to inform the client that that's the case, that they are going to be, yes, I can send the execution to this broker who may be a friend of the client, but I've got to warn you that the rates that you're getting are not as good as the one that we would normally use. And so long as you've got that, and again, always put these things in writing, as long as you have that, that's fine. You've abided by the standard. Excessive trading to earn commissions is a breach. So if there were discounts for a large lot, but instead you took a lower lot to get more revenue, then obviously that would be a breach. Fee-paying family accounts should be treated like other accounts. We touched on that with market manipulation, how that sort of came into that discussion a little bit, but so long as a family member is paying like any other client, you can treat them like any other client. You don't have to worry about prioritization of transactions or anything like that. Then there's a final point that comes up in the notes here on the standards. If you are hired as an expert witness, you must be impartial. So you can't have a relationship with one of the parties or be compensated by one of the parties or anything like that. You must be impartial if you are employed as a expert witness in this sector. And then finally, investment managers must follow investment policy statements, IPS, sometimes it's GIPS, General Investment Policy Statement. They're not required at all firms. It's not even within the standards here. It's not a breach not to have a IPS, but it is a breach to say that you have an IPS when you don't. So do keep that in mind as well. So let's have a quick question here. So which of the following is most likely a breach of Standard 3A loyalty, prudence and care? Using directed brokerage to purchase research from a firm not known for best execution. Well, we're not executing there. We're just using a bit of brokerage. So yeah, it doesn't really sort of stand out as a breach because they're not known for best execution, but it was directed brokerage anyway. So we were told to send our brokerage that way, and we're just purchasing research. So B, a manager of a corporate pension plan takes the management's suggestion to invest nearly the entire plan in the company stock. So the company that's doing the investing. Well, that's obviously going to be a problem because management has come in and said to that investment manager, right, we want you to take all of this, and instead of acting on the client's best interests, we want it all in this company. Now, the company may be great and it may yield a great return for the investors, but the investment manager is not free to make the best decision for the clients. He's being directed to trade in a certain way. So that's definitely a problem there, but we should always check C and D. Failing to vote certain proxies of a client. You'll see this come up sometimes in these questions. If there's proxies, should you vote all of the proxies for the client? And the answer is no, you don't have to. If you can vote a small portion of the proxies and not necessarily show your hand to the rest of the market that this is how many clients you're representing, that's fine. So you don't have to vote all proxies as part of these standards. While trading on behalf of a pension account, an analyst receives special research reports from the brokerage firm with whom she is doing the trades. That's not a breach if you're getting them. Again, if that was influencing your decision to trade through that broker or not, then that would be a problem. But that's not what this implies. So B is obviously the answer there. Management interfering with the investment decision is definitely a breach of what's best for the clients. Okay, so Standard 3B, fair dealing. So no selective disclosures. We talked about this last time in market manipulation. You can have different levels of clients and you can have different subscription levels, but within a level of client, so premium clients, standard clients, etc. Within a level, everybody has to be treated the same. You can't have, I'm just going to tell this guy who's my friend or I got on really well with about this investment opportunity before anyone else. You're not allowed to do that. Trade allocation policies should be systematic and fair. So when it comes to allocating the shares bought as a lot to the individual clients at a certain level, it should be systematic and fair. There should be no favoritism again. So this is more in a case where there may be a large allocation and it needs to be broken up between the clients. And how is that done? So again, that's just making sure that everything's fair, everyone's treated the same there. Do not trade ahead of clients on personal accounts. Again, we talked about that in market manipulation. In that case, it was a form of manipulation, of saying to all of your clients, hey, this is a great buy, but you've gone and bought beforehand, hoping that they're going to raise the price of your investment. But a similar vein. So in this case, it's like just don't trade ahead. It's getting that same advantage, but for a different reason here. And do not unfairly favour one similar client over another. So we've kind of already covered that in those first 2 points there as well. Let's have a look at a question. So Sally Forth, CMT, is a senior hedge fund analyst at a leading investment consulting firm. After thorough analysis, she recommends Fund A, which has consistently outperformed its peers to her clients. However, at the same time she recommends Fund A, she liquidates her position in Fund A to cover a cash shortfall in her personal account. Clients have not been disadvantaged. It could say they're actually advantaged because she actually created more liquidity for them. But has Miss Forth violated any standard, and if so, which one? So A, no, she's compliant. B, yes, she's violated Standard 3A, loyalty, prudence, care. She's violated Standard 3B, fair dealing. Or D, she has violated Standard 6B, priority of transactions. And so again, Standard 6 we'll obviously get to shortly. It's all about conflicts of interests. Priority of transactions is, again, there's a bit of overlap there. But that's not what's happened here. So obviously, if she knew or if she suspected that Fund A was a bad fund and underperformed every other fund, and yet she said buy it while she liquidated, that would be a problem. Then that would be a breach of the standards. If she bought instead of liquidating, and at the same time as she put out the post or the recommendation to her clients, that would be a breach. But this scenario where she is selling, liquidating her position for personal reasons, and she's telling all of her clients to buy, and it's justified, it's a good fund to invest in, then there is no breach in this. She's compliant in this case. Okay, Standard 3C, suitability. So no blanket allocation across accounts. This is a situation where if there is many different types of clients that you're dealing with and they have different needs, you may have some nearing retirement and some 20-year-olds just getting started. You wouldn't do a blanket allocation across everybody because their needs, not every investment is suitable for every investor. And so it's having those grouped and making sensible allocations based on their risk profiles. Consider investments from a total portfolio perspective is what we have to do here. That's how we determine if something's suitable. Does it fit? You know, if they're too heavy in tech, then maybe adding another tech company into their portfolio doesn't make sense. Consider client circumstances and update the investment policy statement. So the way that the policies are defined in the IPS may need to be updated based on their circumstances. So an IPS is really an evolving document in a firm. And so as new information comes out, new scenarios come out, they should be getting updated in that document. Follow the investment mandates. So again, the reason why we have an IPS is so that we don't have to rely on portfolio managers and fund managers making individual decisions and flying by the seat of their pants, but rather they are following the IPS and they're following the mandates that are created and what the clients are expecting. When using sub-advisors, do not simply pick the cheapest, but again, we're always looking for what is best for the client, not necessarily what's best and cheapest for us as a firm. Do not allow short-term remuneration to override long-term objectives. Again, it's that same theme. Put the clients first. Put the client's profit first above our own profits. That's the underlying theme that you'll see again and again. So again, a sample question for this one. According to the CFA Institute Standards of Professional Conduct, when a client asks her portfolio manager to change the current investment strategy of the client's portfolio, what should the manager do? Or the manager should. So A, examine whether the strategy is appropriate and inform his supervisor if it isn't. Or B, obey the client's request without question. C, examine whether the strategy is appropriate for the client and explain the implications of the new strategy before implementing the strategy. Or D, explain the implications of the strategy after the member manager implements the strategy. So just go ahead and do it and then explain it. So obviously, again, just remember this type of question, particularly if it's talking, sometimes these questions will say, okay, according to Standard 3, just remember, okay, Standard 3 is duties to clients. Got to put the client's best interests first. Now, in this case, the client is saying, I want to change my strategy to this. And it's kind of a hard one because even though that may not be the best for the client, if they want to do it, then, we would have to follow them. So out of all of these answers, answer C is the right one because our responsibility is to explain why we think it may not be the best strategy. But if they still, after that explanation, they want to go ahead with it, then yes, we would obviously have to do as they wish and make those changes to their investment strategy. So C is the answer. I would add that you would have to get that in writing, and you would have to have in writing that you sent to them why their suggested strategy wasn't the best for them. And if they intend to continue on with it, then you would ask them to put that in writing as well. So you've got all of that backing you up. Standard 3D, performance presentation. So again, this one's quite important for us as technical and quantitative analysts. So no cherry picking of periods, accounts or methods. We can't go through picking little windows of time or if we want to report on accounts, there's often apocryphal stories of people who have made great calls in the market in the 80s and 90s who would actually write to one paper saying the market's going to fall and write to another paper and say the market's going to go up. And they would select then, as I wrote in the paper, and they would pull out that story and show it. So obviously that type of behavior would be a breach according to these standards. General investment policy statement, not required. False compliance claims are prohibited. So that's what I was saying before. So don't claim that this is a strategy built under GIPS rules and mandates when that's not the case at all. Performance at the previous firm must be disclosed as such. So if you were working for a previous firm and that firm, you were part of a team and that firm got 25% returns every year for the last 10 years, you can't advertise in your new firm that that's the results that you got. You would have to disclose A, that it was when you were working for a different firm, and B, that you were working as part of a team. You can't just make a selective type of disclosure like that. No manipulating data or methods to window dress performance. So that would be, in our case, changing the parameters just so that the past performance looks better than what it should do. Question here, when members and candidates report performance data according to the standards, it is A, permissible to leave details out in a brief presentation if they are referenced and made available upon request. Or B, a requirement to present composite performance rather than individual account performance. C, recommended that a minimum of 5 years of performance history be included. Or D, a requirement to present GIPS compliant performance data. Now D, we've already talked about that. That's not a requirement here in the CFA standards. C, minimum of 5 years, the standards don't talk about that. So there's no requirement for a minimum period, etc. It's what's appropriate to the strategy. If I was doing a short-term strategy, 1 year to 5 years may be suitable. If I was doing a longer term investment strategy, then a longer window with different phases of the market would be important. B, a requirement to present composite rather than individual account performance. No, the standards are silent on that. A, it may look like, hey, we're not giving the information to the client, so because we're not reporting all the information. But sometimes in a brief presentation, it's not appropriate to go into all the detail. It's enough to have the headline numbers, but the standards do say that you must make it available. You must reference these results came from this paper, and you can get that paper by contacting our department, or here's the web URL, etc. Okay, standard 3E, which is preservation of confidentiality. So no divulging client information, even to procure donations. You'll see questions come up like this where such and such is working for a charity and they want to raise money for this wonderful cause that nobody would have any issue with, nothing to do with the markets. You are still not allowed to hand out client information without that client's consent. So you can go to your clients and you can say, hey, I'm working with this charity. If you'd like to participate, click on this link and make a donation. That's fine. But you can't give your clients' details to anybody. Does not preclude disclosures required by law. Obviously, if the regulators come and they have the appropriate legislative right to get those details from you, well, that's not a breach then if you abide by that. Accidental disclosure after reasonable steps to protect the information is not a breach. So, if something happens at the firm and the details get out and there were good steps in place to try and protect data, but it was just an accident, well, that's not a breach and not a breach of the standards as such. So again, question here, Jackpot CMT keeps a list of his clients' birthdays and personally sends them birthday cards each year at the appropriate time. With respect to this action, which of the following may be a violation of Standard 3E, preservation of confidentiality? The mere act of sending a birthday card? No, because the data's not getting out there. Sending a gift along with the card? No, there's no issue with that. C, all of these, or we haven't looked at D yet. D, hiring a company outside the firm to perform the task. So that would be a breach because he would be giving all his clients' names, addresses, birth dates to this third-party company. And that then is a breach of the standards. You can't do that. Now, even though that company has no interest in financial, isn't selling anything to those clients or anything like that, it's still a breach. We can't do that type of thing according to the standards. All right, we'll continue on with Standard 4 in the next video.